Welcome back, guys, to another Zero DTE video, and today Ernie's going to be talking about volatility regimes, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy, guys.
You're not trying to sit there and manipulate your trade and adjust it every part of the day to try to capture the maximum profit. Because I guarantee if you do that, you're going to lose. I don't know how else to say it. You sit there trying to be a scalper and a manipulator of the market, thinking that you're smarter than the market, you're going to lose. What we do is we put on asymmetric trades, super low risk, high potential profit, and we play the probabilities. That's it. We put the trade on. If it works, it works. We manage the profit if it comes our way. If we don't manage the profit, we don't manage the loss. End of story. You do that consistently, you're going to make consistent money. As a institutional trader, I spent tens of millions of dollars trying to come up with algorithms that could determine the market direction every day. I saw fund managers, when I worked at Fidelity, they spent billions of dollars trying to do this shit. And they still do it to this day. They still can't figure it out. Everyone thinks that they have an idea.
What about the artificial intelligence? Is that working?
That's a good question. Maybe the artificial intelligence will be able to see patterns that we can't see. So we're developing it and we're going to see what happens, but I'm not banking on it. Still, the way to make money is by taking the proper risk and playing the probabilities. Our strategy has edge. If you trade with the trend, if you put on an asymmetric trade on the zero DTE, you adjust your exposure based on the amount of volatility, you will make money. You'll have a small edge where you can, on average, your winners will be approximately double your losers. And your win rate will be around 50%. Your drawdown will be around 6% if that's what you manage. And that makes money. That makes really good money. It's boring as hell, but it makes money.
Hey, Coach, could you explain or define local implied volatility?
Yeah, so I look at volatility in two spectrums. There's what I call the volatility regime. That's where the VIX is on a daily basis. It's showing us it's either low, medium, or high. And it doesn't change a lot from day to day, right? It stays approximately, and every once in a while it spikes and drops and stuff. But even then, it takes a couple of days for it to really move from the Goldilocks zone to the zombie land or to chaos. Mostly it's just hanging out there. It's been hanging out below 17 now for a year with an occasional spike up into the Goldilocks zone. So that's the volatility regime. That gives us our basic range. Then there's the local volatility. That's the change in volatility that happens that day, that morning, due to energies that come in and out of the market, economic reports, the Fed, geomacro economic events, whatever. And they change that volatility that day by some percentage, 5%, 10%, 15, 20, 25%. Those are significant changes. We're looking for those changes so that we can adjust one side of the range or the other side of the range that is dictated by the volatility regime. So it's like force measure, it gives us our range, and then the fine measure that tells us what side of the range to play on. Does that make sense?
Are you saying that the volatility regime equals historical volatility, Ernie?
You can measure it by this historical or implied volatility. We use the VIX. I'm just looking at where volatility is currently in the market, which VIX is essentially implied volatility. Implied volatility differs from historic volatility by about, I don't know, 9% or 6% or something like that. So we just use the VIX. It's an easy measure. It's out there. Everyone can see it. Everyone uses it for basically the same purpose that we're using it for, and that is to adjust our exposure to risk. Because it works the same for every other options trader. The VIX starts pumping up a little bit, all of a sudden options get cheaper because the rate of decay is delayed. That's our opportunity. We act on that acceleration and delay of premium decay. By adjusting our exposure to that, we gain an edge. We're trying to maximize our ability to capture it on that zero DTE day. By doing that, we're trying to maximize our exposure to the directional move by trading with the trend. Doesn't mean we're perfect. It just means that by going with the trend, we're going to more often than not capture it.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.